the East Africa pension pool it's currently estimated to be approximately more than $40 billion and growing every year. The current investment pool for the pension funds is largely on the government bonds, but there has been a shift where they have been looking at diversifying into different asset classes, with real estate being one of the good examples where the So the panelists on stage are market experts across pensions and real estate, and will help shed some light on how the diversification into real estate can be achieved. And I'll start with Mercy. Morning. It's still morning, yeah, it's still morning. So Mercy, why isn't institutional capital flowing from East Africa pension funds into real estate, and what can be done?
Thank you very much, Immaculate, and good morning all. As introduced, my name is Mercy Thuo. I work for CPF Capital and Advisory, leading the investment bank arm of CPF Group. So Immaculate, onto your question. Allow me to, first of all, start with a very interesting observation from the recently concluded Africa Forward Summit that just ended yesterday, as well as the AFC Summit that was hosted by Kenya, I think last month. And my response is basically a build-up to the previous panel discussion with the fund managers. It was very clear that there's definitely not a liquidity problem. We have capital in Africa and East Africa, and this capital and liquidity is significantly enough to build the entire continent. So your question about regulatory and structuring, one, strike off the issue of capital because we do have liquidity in Africa. I also believe that we do not have an issue with regulation because from a pension fund perspective, RBA, the Retirement Benefits Authority, the authority that regulates pension funds, has created a very enabling framework for investing. If you look at Table G, which is basically what guides fund managers on where to invest and the limitations for allocation of funding, the real estate category, there is 30% that pension funds can invest in real estate directly. There's an additional 30% that you can invest in real estate investment trusts. And we also have an allocation to other indirect investments like private equity, infrastructure-linked investments, which is at 10%, as well as unquoted equities. And even in PE, I know Peter can attest to this reality because of the IHS fund which he capital raised for. It's not straightforward. I believe the gap is in structuring, Immaculate. And if you look at mature markets like the UK, my dissertation focused on open-ended property funds. And one of the key highlights of my dissertation was that institutional investors will only invest in vehicles that are governable, very well structured, and regulated. Yeah? And I'd like to make a very honest admission. And most of my colleagues in the industry have been asking me this question. We just had a discussion with Sam and Timothy from the Batian Fund. One of the reasons why I have ventured into investment banking with a valuation background is because of my passion for investments and financial structuring. Because I realized as practitioners in real estate, the assets are there. But there's an issue of having this capital flow into the real estate assets. So what is the issue? Yeah, and I know I'll be talking about what we've done at CPF Group to just speak about this. But the issue is in structuring. We need to emulate what mature markets have done. As participants in the industry, we need to come together to see how we can be able to structure investable assets like pooled property funds, Big ups to Gen Africa, who have created the Batian Fund and are really trying so hard to fundraise for it. But also, even as we say that there's an issue with structuring, I must applaud some of the players in the industry who have, made the strides. Like Centum, I understand Triffic is in the market fundraising for $37 capital raise for their REITs at the Special Economic Zone. We have ALP, and no Ragav is in the room. Congratulations on launching the ALP REIT. We also have other players in the market like Mbithe, who are really trying to reshape the real estate industry. So the opportunity is building the right structures capable of converting the East African capital into investable real estate assets. And that is exactly what you're doing at CPF Capital. Yeah, thanks.
Hi, Ewan.
Hello.
If you could introduce yourself first before I ask my question.
Ewan Cameron, Westmont Hospitality, we're a family fund. And we have, to give you an example, we have collaborated with Actis, and we're the proud owner of the Radisson Blue Upper Hill. So welcome to one of our assets.
Fantastic, thank you. Other capital markets invest in property and because property provides stable annuity income. Why isn't there greater need in East Africa for them to invest in real estate?
Good question. As Mercy just mentioned, I think the regulatory framework has changed. We've mentioned this morning on the panels with regard to returns of bonds. And if you're looking for a structure where you can have a hedge against domestic inflation, in hospitality where you can access foreign earning income, it then puts you in a position where you become curious as an investor. In the real estate market, we've heard about the ebbs and flows of different asset types. Hospitality has gone through an evolution within East Africa in the fact that there's effectively 3 different types of hospitality investing. One is developing, greenfield, and I'm sure many people in the room have heard horror stories with regard to time overruns, cost overruns, and terrible gearing and structuring with regard to debt. And to be candid, potentially the DFIs haven't really enabled that to be commercially attractive. So that's made investors very cautious about investing in greenfield hospitality developments. Secondly, you have the second type, which is hotels that are in distress, that then needs to go through an evolution with regard to achieving stabilized and profitable income. That's more difficult if you're a REIT structure and you're looking for a fixed annuity income and you're looking to return net profits each year. But if you are in, as Mercy mentioned, maybe in a pool fund structure, you're looking more in a structured real estate vehicle, then absolutely you're looking for an entry and an exit, which generates a positive IRR, and those opportunities are available today in East Africa. And then thirdly, you have assets that are stabilized. And if you're thinking about yourselves of investing in a shopping mall or investing in, as we heard this morning, in residential, which struggles of scale, if you have an asset that carries an international brand, so I'll give an example here, it carries a Radisson name, it means that when you're looking at an exit, if you were potentially looking to sell that on to an institutional type investor, it's very easy for them to get their heads around the fact that it's branded Radisson, it's international standards of fire life and safety, it has all the compliance issues resolved, it has clean title, as we discussed in earlier panels. It makes it a very easy with regard to de-risked on paper investment. It really then just comes down to the numbers. So I would say that now institutional investors should be looking at those stabilized earnings in the key markets in East Africa as an opportunity. And I think those investors that are looking for a more aggressive real estate return should be looking to take advantage of the fact there is distress within some of the real estate in hospitality today, where you can get in at a relatively low price and you can look to exit at a reasonable IRR.
Great, great. Hi, Beryl. Please introduce yourself.
Hello, everyone. My name is Beryl Bunyasi. I'm a senior investment consultant at Zamara. We offer actuarial and investment consulting to pension funds in Africa.
Great. So real estate assets historically have been known to have low returns. And for pension funds where you need to liquidate to pay your pensioners, you would need quick access. So how or what structural changes do you think would make real estate fit for purpose for pension portfolios?
So typically, when you look at the East African space, for most pension funds, we have had property in our portfolios through direct ownership, which is where we've faced the most challenges. The first thing, as you've said, is the property returns. On average, when we look at the Kenyan market, most of our pension funds have an annual return of 6% before expenses. So you can imagine, in comparison to what was mentioned in the panel before, when you have 18% from fixed income, it has become a difficulty. Second thing has been property management, and also the fact that our valuations for our properties haven't been very clear. So when you look at what we need in terms of structural changes, the first thing is we need the property sector to be more institutionalized. That means we need better property management when it comes to the pension side, better valuations. Essentially, we need more view of what these properties are actually worth. We've seen so many situations where you have an asset worth $1 billion in your financials, yet when you're trying to sell, you're getting 600 in the market. So you can imagine taking such a haircut when you have member obligations to actually pay out. The second thing that is really important to look at is, in terms of liquidity, it's not really the main constraint that we have. Pension funds are long-term investors. We are here buying 30-year bonds and so on. It's having clear exit pathways. So we just need to know that when we need to exit, there is a way to leave. So it's essentially creating that. And also on the development side, development risk has been quite a topical issue. Most people are trying to develop. You have so many issues. We are not professional property developers. So pension needs more stable returns, predictable returns. So creating structures where when a pension fund is coming in, the development risk factor has already been catered for. So we need stable returns, something that we can see and depend on the long term.
Speaking of institutionalized real estate, and this question goes to Ewan, do you think REITs are the right investment vehicle, or do you think we should explore pooled non-listed structures?
REITs provide almost that annual annuity structure or return. So for an institutional type investor, having exposure with regard to REITs may well be an attractive model. However, there is tax benefits, and you really need to understand what those slices of return that come from. So as I said, if you've got a stabilized real estate venture and it works within that model and you can return, good, as you say, maybe 6-7% per annum, that would then make sense in a REIT structure. However, if you're looking to do a turnaround and you're looking for a higher return, then I would argue that probably a REIT's not the best structure. As an investor, you need to make a decision about, do you want to have those annual tokens, or do you want to have a greater exit yield or IRR, and then it's more appropriate to be a non-REIT structure. And then I think it's down to risk and your appetite. So maybe at the beginning you look at pooling capital. Once you've got familiarization with the asset class, then you maybe look to set up your own real estate investment vehicle.
So I'll switch gears and go into regulations. And hi, Peter.
Hello.
If you could kindly introduce yourself.
I'm Peter Mayavi. I'm the Chief Capital and Development Officer for Centum Real Estate. And I'm happy to be here. Thank you.
Okay, thanks. The key issue that we have with real estate on the pension side is the illiquidity. You've addressed some of the ways that we can address that. However, Peter, do you think that RBA should mandate a time-bound divestiture program for pension schemes who've outgrown their property exposure? What structures would make sense? And that, I guess, related to that question as well, do you think RBA should follow South Africa and Zambia in prescribing the minimum allocations to real estate and not just the maximum caps?
Okay, I think I'll start with the historical issue. A lot of the pension schemes are saddled with what I can call legacy exposure to property. And how this happened was the parent companies would sometimes not be able to, remit pension contributions, and then they would end up allocating property as payment for these pensions. So you end up with a situation where, let's say, for lack of a better example, maybe the University of Nairobi is not remitting pensions, so they talk to Unipen and say, okay, we have this particular tower or this piece of land, so instead of us remitting the actual pension, we will give you this property. So you're just sort of kicking the can down the line. Unfortunately for that is then you have a lot of pension schemes that right now are saddled with, legacy properties, which are very, they are not the returns, as Beryl was pointing out, the returns are not as, they're not market rate. If you're talking about 6% returns before expenses, that means the real returns are somewhere in the 3-4%, which compared to even money markets, let alone what the government is borrowing at, it's not a return that you can talk about. To make matters worse, a lot of these pension schemes are the defined benefit schemes, not the DC schemes. They're not the contribution schemes. So defined benefits means a lot of the members are older members. They're now getting to retirement age. They need liquid, settlements. They don't need. They cannot be allocated land as part of the pension settlement. So what we are seeing now in the market is you have a pension scheme that, despite what Mercy was talking about 30%, which is what RBA is prescribing. Some of them are even up to 80% in assets. In the assets is land and illiquid assets, which is not prudent at all. So what am I proposing? I'm proposing that maybe RBA needs to come and maybe prescribe a phased reduction in these assets in a way that can be where the value of these assets can be realized. Because as a pension scheme, maybe you could be holding, an acre in Upper Hill, which in your books you're holding at, 800 million, or, because every year you've been revaluing it upwards. But when you go to the market maybe is only willing to offer 300 million or 400 million, because that's actually what the real value is. So what I'm proposing is maybe a phased exit of these properties, so that they can realize the liquid value of these properties. And we are seeing that. If you saw in the media the other day, the Teleposta pension scheme has actually put a lot of their properties onto the market, because, as I said, you have older members, they're retiring, they cannot be allocated land as part of their retirement. In terms of you're talking about a floor rather than a ceiling. I think this is a problem I had when I was actually fundraising for IHS. Because RBA says in your IPS as a pension scheme, you can invest up to 10% of your AUM in alternatives. But they say up to. They don't say what the minimum is. So it means that when I go to Beryl, she says, she compares me to the government paper, which I'll never be able to compete with the sovereign in terms of, risk. So in that case, then you see, then there's no justification for any asset manager to allocate funds to, to alternatives or to, like the rental program that Sam is talking about, things like that. There's no minimum. What I'm proposing is, why shouldn't RBA says that a minimum of maybe 2 to 5% of the AUM should go to maybe alternatives? I know I'll fight with a lot of pension scheme allocators here, but I believe that's the only way to excite the market. And as I said, this has been done in Zambia, it has been done in South Africa. South Africa passed Regulation 28, which prescribes a minimum, I think, between 2 and 5% minimum into alternatives. And this, I think, is the only way to, unlock this AUM into these assets. Thank you.
So maybe to put it into context, I need to say what the return expectation is. So the return expectation is not what a government bond is giving you at the moment. For most pension funds, our main mandate is to ensure that members are able to retire and retire well, which means that when we're looking at inflation, at the very least, when you retire, you should be able to buy the basket of goods at that time. So at the very least, we expect inflation plus 2% or 3%. So I believe that's an achievable return. Each asset class has a place in a portfolio. Not everything should give you 18%, but it should be well diversified. So the aspect is not just to say that we want what a government bond is giving. It's for these other asset classes to give us the same comfort that we are receiving from that. In other words, as I've said, the stability that we are receiving from that sector, but also in terms of the governance. Governance is key to any pension fund, so ensuring that that is set in place, and it's something that's understandable and something that pension funds can invest in. The same way we say patient capital from the pension side, when you're coming to a pension fund to fundraise, we also need patient pitches from your end. It takes a bit more time. We are a younger industry, may use that term. So it's understanding that you're coming into a different landscape. We have a very serious duty to our members to ensure that things are kept safe. So it's just ensuring that the structures are following that. So we've seen people come through. We have REITs now in the market, property funds. So it is doable. We've seen fundraising happen, but it's just how the process goes. That's what matters.
Okay, thanks. I feel like we were given less time, but I guess I'll ask the last question to Mercy and Beryl. CPF Group and Zamara have significant pools of liquidity. Please, could you highlight, and I'll start with Mercy, what are the key contributions that you have made in advancing institutional real estate?
Thank you very much, Immaculate. Allow me to just build on Peter's discussion about the limitations and the minimums. There's actually an ongoing conversation with RBA to change the allocations, especially for infrastructure projects. So what they're saying is that it will not be 10%, up to 10%, it will be a minimum of. So at least pension funds can be able to, contribute to the development of the country. And this is a discussion you can also initiate on matters real estate as well. But back to your question, what has CPF Group done in this space? We have a bias towards capital markets. And if you look at the last transactions we've done in the market, Talanta, we were the co-arrangers and placement agents for Talanta Stadium, raised about $250 million. But if you look at Talanta, the way we look at real estate, it's not just a standalone building. It has trickling effects on other sectors as well. Hospitality, residential demand, infrastructure-linked development, SME, activity. So it's just not the property itself. There are many other benefits that come along with such a development. We are also the only pension fund that has invested in a REIT, the Imara Lab Trust IREIT. We've also the only pension fund that has invested in the first Sharia-compliant bond, which is the Lindsay Sukuk, whose proceeds were used to develop KDF housing. We also have a footprint in the region. We just set up in Rwanda. We have an investment bank license in Rwanda. We are at the advanced stages of acquiring a hospitality asset, one of the Radissons in Kigali. and many other real estate projects that we've handled as a group, and we continue to promote the real estate sector at an institutional level. Thank you.
So I'll speak more as a service provider rather than a holder of capital. So we are independent advisors to pension funds, and how we have tried to essentially deepen the market is to help bring awareness. So I'm hoping for anyone here who has a fund or a development, they can attest that Zamara has tried to bring awareness, speak to the trustees, help them understand these opportunities. If you have pension side investments, please feel free to reach out to us. So for us, it's more on continuous education, capacity building, and just linking these holders of capital to the investments that are there. So we stand in as a bridge, and not really as an investor, and we just ensure that the industry keeps growing over time.
Thank you very much. Yeah, that's it. Unfortunately, we don't have time for question and answer. We are being kicked out, but thank you so much for your time, panelists.